All right, let's break down the action for the week ending March 27th. Here's your after-hours recap. The major indices were down, led by the Nasdaq. But honestly, that headline number is pretty misleading. Under the surface, it was all about a huge rotation away from growth stocks, driven by two key things. First up, geopolitics. Headlines on the US and Iran drove all the volatility, which slammed the price of oil. So, Monday started off great. Hopes of a diplomatic pause sent stocks rallying right out of the gate. And it was all because oil prices just tanked. That sent the S&P 500 popping above some key levels. But that good feeling didn't last. Conflicting reports brought back all the uncertainty, and oil started swinging like crazy. By Friday, WTI crude was right back up near that critical $100 a barrel mark. And here's the crucial part. Every single rally attempt got smacked down at major technical resistance. That's a bad sign. What's really fascinating here is the split this created. It was truly a tale of two different markets. On one side, you had struggling mega caps. On the other, small caps were actually holding up pretty well. And get this, the mega cap growth ETF dropped over 4%. Meanwhile, the Russell 2000 actually finished up. You could see this rotation play out at the sector level too. Let's pull up the weekly scorecard. No surprise here. Energy was the big winner. It surged over 6% as oil shot back up. Materials did well too, thanks to supply worries, and defensive plays like utilities caught a bid late in the week. Now for the losers. The mega-cap heavy sectors got absolutely crushed, which confirms what we saw earlier. Communication services got hit the hardest. It was dragged down by Meta and Alphabet after a negative court ruling. Infotech was another weak spot. We saw big losses in software, and the chip stocks were really struggling. And heading into the weekend, the market's fear gauge, the VIX, really spiked. Traders are clearly getting nervous. So what does all this mean for next week? Let's quickly break down the key takeaways for you. First, the market's completely captive to macro news. Second, that mega-cap weakness is a real drag on everything. Third, those key technical levels are acting like a brick wall. So for now, the path of least resistance still looks lower. So the big question for traders is this. In a market this fragile, where do you find safety? And where's the risk?